timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
Pete Weitzner, joined by Dr. Esmael Adibi, the economist here at Chapman University and head of the Anderson Center for Economic Research. Well, boss, as we record this, we mentioned, individuals' two biggest investments, their home and likely their 401k in the stock market, which as we sit here early February on the Dow and S&P 500 closing it on a record, and home prices, look, in Orange County, a 25% increase in 2012.
Yeah, be careful with those numbers. Yeah, be careful on those numbers.
Data quick, I respect their number.
Yeah. Oh yeah, I respect the numbers too, but the methodology, how it's computed, is very important. Because what they do, they look at all the homes that were sold and then get 50 of them below, 50 above, that's the median, that's what they report. So we have seen some activities now, especially the latter part of 2012, on the high end of the market, that is $1 million home are being sold. And if more expensive homes are sold, the median by itself is going to be pushed up. Having said this though, home prices, no question, existing home, stock of housing, like my house, has appreciated, but nothing close to 25%. More realistic number is about 6 to 8 percentage point. However, having said this though, you get the newspaper, in the next couple of months, you will read this 18%, 19% increase year over year, because last year, beginning of the year was extremely weak. Most of this upsurge showed up latter part of 2012. Overall though, like for this year, for Orange County, for Southern California on average, we see about 6% appreciation. So that 25%, you have to really take it with a grain of salt.
And we'll get to that downside. Whether it's 25% median is anomalous number, 8 to 10 is more accurate, but also on a very positive note, housing starts, because that's what really creates
that is
jobs.
Important. Exactly.
3 per new home built, and we're now at an annual rate of 950,000. Give us some historical context for that number.
We were building about 6 years ago, before recession started. These are national numbers. We were building about 1.8 million homes annually. It dropped sharply over like 3-4 years, and it went down as low as 550,000 homes. So you can see what a big drag construction created. Since then, the 550 became 6 and the 7, and last year, 2012, was the best one, because by the end of the year, we were pushing against annual rate of about 950,000. Sure. We don't think we're going to go over 1 million, but we think this year it's going to hover around 900, 950,000, and that is good for the economy, because remember, these are new homes we're talking about.
They're building in some of the hardest hit areas, Florida, Nevada,
exactly.
Even here in Southern California.
Exactly.
Now, I mentioned the downside. Traditionally, and I'm going back a ways,
yes.
There was a thing, and your colleague Joel Kotkin is the Urban
yes.
Futures fellow here. Traditionally, the median multiple was 3, meaning homes sold for 3 times median income. The median income in Southern California was 100,000. The home sold for 300. Those days were long gone.
Yeah.
And then we had maybe a historical median of 10. In the crazy times, the ninja loans and all that, it went up to 11. All the way back to 5 in 2009, but it's moving up again. In San Francisco now, it's close to 8%. 8 on the median. Who can afford those homes?
We have to be careful. I mean, I have quite a bit of respect for George Kotkin, and he wrote the excellent, op-ed piece recently addressing this. First of all, let's understand that ratio, the 3 that you say was the norm, that's out now. And the reason is because investment in home as an asset became much more attractive because of capital gain exemption. And that kicked in latter part of 90s. So you could take multiples of 5 and 6, and that would be respectable. Now, if you go to the multiple of 10 and 11, as it was, obviously it's pricey. And
by the way, not to mention mortgage interest deduction.
Exactly. That was always there, but on the top of that capital.
But if we're comparing it to, say, appreciation in stocks or something, right?
Yeah, but when you look at housing, you have to be careful. Sure, you look at price divided by your income or median income, and you look at that as a multiple. But what is important in the housing is affordability. And affordability is not just the price, it's the mortgage rate.
But that's moving up too.
Yes, but so given the environment currently we have, with mortgage rates between 3.5 to 3.75, that multiple is absorbable, and we can continue at that rate, home prices appreciating, and income hopefully catch up with the same percentages.
Sure.
But if mortgage rates go up, and it is expected to go up as soon as the Federal Reserve starts, buying these mortgage-backed securities. Then we're worried about whether these high prices are sustainable.
And we're being hardest hit here. Home ownership overall is down. It used to be 70% in the country. It's down to 65%, 55% in California, and the hardest hit, we know, young people, 25 to 35.
Yeah, and it's understandable. It's unfortunate, but it's understandable because recession hit us much, much harder than the national, picture. So what happened? We lost lots of jobs. So the kids who were out there, living on their own and working, they're coming back to their parents, and as a result of that, either they sold the house or foreclosed or short sale. So home ownership has gone down, but at the same time, the rent have gone up because most people became rentals. So that's why home ownership is dropping. And plus, relatively speaking, our homes are much more expensive than the national average.
And a lot of these housing starts, by the way, are multifamily.
Because of the rent, of course.
We'll finish with a quick comment on gas prices, because continuing the discussion of the difficulty, how expensive it is to live in California. We have the second highest average gas prices.
Yes.
We'll talk taxes next time at $3.83 on average. Now that's down 80 cents from just 3 months ago, but I know we got to switch to the summer blend, and it looks like we're trending higher again.
This is the problem we're facing here in California, and unfortunately we don't address it in a fundamental fashion. As you just mentioned, 3 months a year we go to the winter blend of the gasoline, and that winter blend is available from other states, other sources, so we can always rely and bring those in. But summer months, for almost 9 months, we're using this special blend, which is only produced by refineries within the state. And if one of these refineries go through maintenance or fire or something,
they always seem to.
No, they have to do their maintenance. That's understandable. And usually they do it this time of the year because it's not as much demand getting ready for the summer. And if it lasts a little longer or too many of them, prices go up. But that, when we look at that together with higher taxes, high gasoline prices, that's not a good news for us, because consumers, as we mentioned, previously in different show, their taxes are going up, and if gas goes up, it's like a tax, and that's not good news for consumer spending and retail.
We'll talk about those tax increases, the ultimate settlement on the fiscal cliff, and the debt ceiling in our future program, our next program. I'm Pete Weitzner, and this is the boss, Dr. Esmael Adibi, the chief economist here at Chapman University.